G'day folks, welcome back to another update. And today we're looking at the S&P 500 only, and we're going to see if it's actually overcooked or overbought. Is there a major correction due? So we'll look at the reasons why that's a possibility sometime in the near future. We're always going to look at divergence is one of the main reasons we look at a potential reversal. So before you get going into the chart, make sure you hit that like and subscribe button to support the channel. First off, why the US market and why the S&P 500? This is just a graphical representation of the US market, comparing it to China, Japan, Hong Kong, the UK, France, and all the others combined. And as you can see there, in terms of market cap, the S&P has got approximately $50 trillion in market capitalization. That's as of today, 2025. In terms of a deeper dive into these numbers, this is the ranking. So the US at the top there, and that includes the S&P 500, the NASDAQ, and the Dow Jones. So approximately $50 trillion, and that's home to Apple, Microsoft, Amazon, etc. The next second in rank is China with a Shanghai Shenzhen index. That's between 10 and 12 trillion. That's largely more a domestic focused market within China. Then you're followed by Japan and the Nikkei, the 225. That's a 6.6 to 7 trillion. Major exporter of stocks, i.e. Toyota and Sony. The Hong Kong Hang Seng Index, that's 4 to 5 trillion. Gateway for Chinese and global capital. The UK FTSE, 3 to 4 trillion, financial and energy heavy index. And then we've got France with a CAC 40 between 2 and 3 trillion dollars, luxury, banking and industrials. Now in terms of a potential reversal, we look at the top S&P 500 corrections in the bear markets by year. At the top there you can see the 1929-32 Great Depression. That dropped by about 86% over several years. Next we've got the 73-74 oil crisis and stagflation dropping by about 48%. 1987 Black Monday, that was the S&P 500 plunged around 20%. 2000 to 2002, the dot-com bubble burst, dropped by about 49% over 2.5 years. That also included the impact of 9/11. The 2008-2009 global financial crisis dropped by a whopping 57%, not quite as big as the Great Depression, but still quite massive. 2020 was a COVID crash, 34% drop over just over a month. And then we got more recently the 2022 inflation and Fed tightening fell by about 25%. So if you're a regular follower to my videos, you know that I always look at the long-term trends, and that's deliberate because we always look for any divergence. So again, this is the S&P 500 on the monthly, the weekly and the daily. I won't talk too much about these particular charts today. What I want to do is jump straight to the daily and the hourly. And again, I'll come back to the daily and the hourly in terms of where we are today. But let me first off expand on the daily chart. So we normally look at the recent history to identify any divergence. And again, I'll come back to where we are today and what we can expect in the near term. But what I want to do here first, I want to zoom out, going back to around about 1972. Unfortunately, the chart doesn't go back to the Great Depression. It goes back to about 1972. And what I've done here, I've identified these circled areas where each of those major crashes happened or corrections happened. So you can see here, back here was 1973-74, the oil crisis and stagflation. This one here was a Black Monday, 1987, dot-com bubble burst, 2008 global financial crisis. Up here was the 2015-2016 drop due to China's slowdown and oil price collapse. This one here was the 2020 COVID correction, and then here we had the 22 inflation and Fed tightening. So what are we looking at here, and why have I identified these areas? And down here you'll know, again, if you're a regular to my channel, we look at the CCI1500 compared to the moving averages of the price. Now again, zooming in, we look at declining for a bearish divergence. We look at declining CCI peaks versus higher highs on the price. You can see there I've marked these rectangles where the price has come back and corrected according to the bearish divergence. So back here, for example, we had this little one here versus declining CCIs. That broke down there and hit our 23-38% target range. So again, just measuring that one from that high, we go back to that low. Actually, we'll go back to this low here. That's at 23-38%. So it depends where you draw the divergence ranges. There were smaller ones. You'll notice here there are a lot smaller ones in there. So again, looking at a bigger picture, what we're trying to identify is any potential crash. So let's go back to this one, for example. Back here, this was the 22 inflation Fed tightening. we had a very small bearish divergence there. You can see there it fell off and the price started declining along with the CCI dropping in tangent. Eventually it dropped to a point where it made a bit of a recovery, and finally we had a bullish divergence, higher lows versus lower lows on the price, and then from there it actually bounced and continued in an upward trajectory. Back here, this was the COVID crash. Again, notice here we had almost a double top on the CCI versus higher highs on the price, and that actually fell quite sharply. And again, the CCI and the price quickly corrected after a few months, and it continued to move in an upward trajectory. So this happened quite frequently. Back here we had the 2015-16 China slowdown, an oil price collapse, a very small one. Nonetheless, it still collapsed due to a bearish divergence. And then we had another very narrow bullish divergence, and that corrected upwards. Again, not a huge one, but still impactful. The GFC, 2008, 2009. Let me just zoom in a bit more, some of these. Again, you'll notice there, we had higher highs on the price versus lower highs on the CCI. Again, that dropped off in line with that CCI dropping off, and then eventually did correct, bullish divergence, and then corrected and continued more at an upward trajectory. That happened over almost 2 years. So I suppose always, I won't go through all of them, but you get the picture. And again, zooming out, each of those areas had divergence in play. And if you'd be following the patterns of each of those positions, you would have seen a potential correction in the market. Okay, so where are we today? So if we zoom in to where we are today, you'll notice here we've got a few bearish divergences. We had a smaller one there that broke down, already demonstrated, but importantly we've got another one currently in play that goes from those peaks. Now notice here what we're waiting for is the CCI has already broken to the downside, but notice the price is still above or just touching that moving average range. What we want to see is the moving average range. That's why these multiple moving averages are drawn as such. It's not a single line, they're multiple moving averages. What we want to see is the band constrict like it did back here, the price fall below that band, and then eventually the band widen and be in a downtrend. That confirms in this case, the bearish divergence or the correction starting. Now, again, we can't tell how far it's going to go, but what we do know is it's going to drop at least around 23-38% level. So let's assuming the price drops from there, and it may continue. Actually, it may actually continue to bounce up from there. We don't know for sure. As I said, I'd like to see these moving averages bend down to be confirming. The CCI is already doing that, but the price is still somewhat trending in an upward trajectory. So what we do is assuming it starts pulling back from where it is at the moment, we take back a Fibonacci retracement from that high, and we measure from that divergence range. So what we do is we take it back to the significant low before that divergence started. So if we zoom in, we mark it. Just for the exercise, I'll mark it as well today. That's a 23-38% Fibonacci retrace minimum. And I stress minimum, we can expect. It could fall a lot further. You'll notice this one here, for example, it fell below the 23-38% and went as far as the 50% of that range. And if I drew that again on that little range there, when that one was in play, so we went back to this point here, that actually bounced off the 50% level. So we can't tell how far it's going to go. What we do know, it's going to hit this 23-38% as a minimum before possibly bouncing. So again, it could just touch it and then bounce, or it could actually fall a lot further. Some of these went a lot deeper. Let's go back to COVID as an example. So if we zoom in on COVID, you can see there we had this long bearish divergence. Okay, so what we're looking for now is we go back to the previous low, significant low. So we take it back to that correction back there. You can see there it just broke below the 61% of that range. And if we went even further, let's move that Fibonacci down to that point. You can see there it touched, again, depends where you draw the Fibonacci, this one touched the 38% range. But I like to take it back to the significant low before that divergence started and play it in smaller chunks. Again, so repeating what we've got, the price may come, if it starts pulling back from where it is at the moment. So the first thing we need to know is, will the moving averages on the price start bending down like it did here? that's when we can actually start confirming that there is a bit of a correction happening with this bearish divergence. And if it does come back from where it is at the moment, that's our minimum target range. It could just touch that or could go further. Now, if this keeps rising and that CCI keeps dropping, we're going to consider it a bearish divergence, in which case we then have to readjust this 50 Fibonacci level. Of course, if this CCI keeps rises from there and goes higher than that previous point, then we're going to invalidate the divergence. So at the moment, it could be early days yet, so don't go placing short orders on it now. Wait for this bearish move to happen with the moving averages on the price starting to turn down. The next thing we look at as well is we also look at the micro level. So as I said in each of my videos when I do these, I look at the various time frames. Here we're looking at the daily. We also look at the hourly. So if you're trading on the 1 hour time period, for example, you'd wait for that to break to the downside on the daily before taking short trades. But try not to trade on the one time frame in isolation. If you're trading on the hourly, look at the daily in terms of a trend. So you notice here, for example, you would have had a nice little drop had you gone short. But again, wait for that to break to the downside. So at the moment, you would have gone long during that period when the price and the CCI were going long on the 1 hour in line with the daily movement. So remember, always do a deeper dive into the trading strategies, referencing the +1 videos. There are some of those attached in the description below. Hit that like and subscribe button to support the channel, and we'll speak to you in a future update.